Welcome to the start of a new module. In this fourth module, we will focus on the strategy we use to actually open position, and that is absorption. First of all, what is exactly absorption and what does it indicate? Absorption is a situation when passive market participants literally absorb the actions of aggressive market participants. Absorption is, for example, a situation where large opposing orders appears, for example, heavy selling during an uptrend, but price doesn't move significantly in that direction. You can think of absorption as a large limit order that aggressive participants keep hitting heavily, but they just can't push it through. This behavior of market participants can be observed through order book or footprint chart. Absorption itself signals accumulation or distribution. Large players enter the market with limit orders, while the mass of aggressive participants ends up filling those orders. In this way, large players take advantage of the strong pressure from aggressors to passively enter the market, and that's the main core of absorption. As I mentioned, absorption can be observed on the footprint chart, and when identifying absorption, we use the same concept we covered in the order flow module. Delta profile, volume profile, price versus participants, imbalances, min delta, max delta, distribution of volume, etc. How to spot and how to understand absorption. Absorption happens when strong buying or selling pressure is present, but price doesn't move in that direction. That shows that aggressive market participants are filling the passive opposite side of the market. Despite their strong pressure, aggressors fail to push the market lower or higher because all of their effort is absorbed by passive participants with their limit orders. That's why it's called absorption. Passive limit participants are absorbing market aggressive participants. Here you can see high volume candle with a lot of positive delta, but price simply rejects this level. Why? Well, because there is a huge limit sell order which is absorbing all of those buying pressure. Someone big is trying to enter the market as a limit participant, using all of this aggressive buying power as a fuel for his position, for his limit position. Same applies in reverse. Here we can see a lot of negative delta, a lot of aggressive sellers trying to push the price lower. But there's someone big with massive limit buy order, which is basically absorbing all of this selling pressure. In case of bullish absorption, a large limit sell orders absorb the buying pressure from aggressive buyers. On the footprint, this appears as a candle or candles with high volume and strong delta, but with price rejection. In case of bearish absorption, large limit buy orders absorb the selling pressure from aggressive sellers. On the footprint, this shows up as a candle or candles with high volume and strong negative delta, but with price rejection. Once the price at the strong key level strongly rejects the level after absorption, a stronger move usually begins. And that's exactly the moment when we want to enter the market. We always trade against the side that has been absorbed. So when we see strong bearish absorption, we prepare to go long, because the big players use the selling aggression to enter a long position with their limit orders, and we want to follow their steps. When we see bullish absorption, we prepare to go short, because the big players used the buying aggression to enter short positions with their limit orders. And again, we want to follow their steps. And now, what is the logic of absorption? Absorption occurs when a large player wants to enter the market but doesn't want to move the price against themselves. Imagine that you have position worth $1 million. If you entered at the market price, first you would pay huge fees because you are entering the market as aggressor. But more importantly, you would move the price against yourself, since you are a large aggressive participant. In practice, it would look like this. If you bought 10,000 contracts at the market, some contracts would be filled at the price you enter, but others would be filled at a higher price, because there wouldn't be enough liquidity for you. So in the end, your average price would be at a higher level, and you would lose significant portion of your potential percentage return. So, in order to enter the market as an aggressor with a large sum of money, you need a level with significant liquidity, and even then, you'll pay enormous fees. For a large institution, entering at market price is therefore very disadvantageous. So as an institution with big capital wanting to enter the long position, you place your limit buy order at levels where significant aggressive selling is likely to occur. This aggressive selling fills your limit buy order, absorbing the selling pressure, allowing you to enter the market with lower fees, and all at a single level, because as a limit buyer, you don't push the price against yourself. And that's how big players enter the market. That's why absorption is one of the best indicators for potential entries, because absorption reveals the presence of big players. Here you can see an example of bearish absorption. A lot of aggressive sellers filled a large limit buy order and the price rejected this aggressive selling. In the end, all these aggressive sellers are trapped because the price moving against them, while the one who had the large limit buy order, which is this green box, filled by these aggressive sellers, is now in profit. So big money institutions, hedge funds, etc. use aggressive market participants as a fuel to enter the market passively. So if you see absorption at strong key levels, it's an ideal moment to enter a position. Here's an example of bullish absorption. A lot of aggressive buyers try to push the price up, which is clearly visible through positive delta. However, at this level, there is a large limit sell order absorbing this buying pressure, allowing a big player to enter the market passively as a seller. After a few minutes, the buyers gave up and the price rejected this level downward. A perfect short opportunity. It's very important to use absorption in the right context, and most importantly, to distinguish good absorption from bad absorption. Because trading is like a puzzle, everything has to fit together and make sense with a given context. Now let's look at how to identify proper absorption and how to use it to enter a position. If you want to continue learning, you can find a full order flow course on our website, including free PDF materials. It features modules explaining the basics of price action, as well as professional order flow insights you won't find anywhere else. If you are interested, the link is provided in the description of this video. Thank you so much for watching.